Alright, so this lesson is for CMA Part 1, and we're already in Lesson 2, Revenue from Contracts with Customers, and Section 1 is about the 5-step model of revenue recognition, or the IFRS 15. So, to provide you an outline, first, I'm going to talk about what is IFRS 15. Second, I'm going to do a comparison between IFRS 15 and IS 8. So for the information of everyone, IS 8 is the old standard for revenue, and IFRS 15 is the new standards. Third, I'm going to discuss in detail the 5-step model of revenue recognition, or the IFRS 15. So we have here, step 1 is about identification of a contract. Second is to identify performance obligation. Third step is determination of the transaction price. Fourth step is the allocation of transaction price to performance obligations. And the last step is the revenue recognition. And lastly, I'm going to talk about the balance sheet presentation, specifically the contract asset and contract liability. So first, what is IFRS 15? Actually, this is a new standard established by the IASB, or the International Accounting Standards Board, for revenue recognition. This new standard is effective for annual reporting periods beginning on or after 1st of January 2018 with earlier application permitted. So what is the main concept of the IFRS 15? So basically, under IFRS 15, revenue is recognized as each performance obligation is satisfied. So when do we consider a performance obligation to be satisfied? That is upon transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in the exchange. Take note, the most important thing is that there should be a transfer of promised goods or services. And in exchange for that, the company who is selling the goods or services should receive a consideration for such transfer. So now let's go to the comparison between IFRS 15 and IS 18. So as mentioned earlier, IS 18 is the old standard, and this has been superseded by the IFRS 15. So let's first discuss about the IS 18. So under IS 18, revenue is recognized when, take note, the risk and rewards of ownership are transferred. So here in IS 18, we recognize revenue if the risk and rewards has been transferred. On the other hand, under IFRS 15, revenue is recognized when the control is transferred, even though the risks and rewards remain with the seller. So the main difference here is that under IS 18, risks and rewards should be transferred. For IFRS 15, on the other hand, even if the risk and reward is not fully transferred, as long as the control is transferred, then revenue shall already be recognized. The main question there is, when is the control transferred? So basically, as I mentioned earlier, control is transferred when the performance obligation is satisfied. So that is when there is transfer of promised goods or services. So why did they implement a new standard for the revenue recognition? So you might be asking why. And the main purpose of which is to improve comparability within industries and across capital markets. Now let's go to the 5-step model of revenue recognition under IFRS 15. So we have here 5 steps. Step 1 is to identify the contract with the customer. Second is to identify the performance obligation. Third step is to determine the transaction price. Fourth step is to allocate transaction price to performance obligations. And the last step is to recognize revenue when obligation is satisfied. So I'm going to discuss each of this in great detail. So step 1, identify the contract with a customer. So first, let's define what a contract means. So per standards, a contract is defined as an agreement between 2 or more parties that creates enforceable rights and obligations. So take note, in order to have a contract, there has to be an agreement, and usually in that agreement, what is stated are the enforceable rights and obligations of each party. So now, not all contracts can be accounted for under IFRS 15. So we have here criteria for revenue recognition, wherein all criteria must be met. So first is that contract is approved by the parties. So basically here, the approval need not be solely in written form. So approval of contract can be in different forms. For example, it can be in written form, verbal form, implied. But the most important thing is that the contract must be enforceable within both parties. Second is, contract should have commercial substance. So what do we mean by contract having a commercial substance? So a business transaction is said to have a commercial substance when it is expected that the future cash flows of a business will change as a result of a specific transaction. So a change in cash flows is considered to be when there is a significant change in any one of the following. So for example, if there's a change in the risk, if there's a change in timing or amount of future cash flows, and etc. So a contract is commercial substance. For example, if there's a transfer of risk and rewards, if a contract states that future cash flows is expected to occur as a result of this contract. Third item here is that each party's rights to the goods or services transferred are identified. So it's understandable here in a contract, typically each party has rights and obligations, and this should be clearly indicated in that contract. Fourth is that it is probable that the entity will collect substantially all, take note, substantially all of the goods or services to be transferred and the payment terms. And last here is that there should be a consideration as a result of this contract, and that consideration should be probable. When we say probable, it means that it is likely to occur. So meaning a contract within the scope of IFRS 15, there should be a consideration or specific amount that the buyer is expected to pay or the seller is expected to receive as a result of that transaction. I hope that's clear. Now, if the criteria are not met, therefore revenue shall not be recognized. Okay? So as I mentioned earlier, all the criteria must be met in order for us to have a contract that is within the scope of IFRS 15. If this is not met, then revenue shall not be recognized. However, we have an exception here. So, for example, if a customer has already paid, so he has already given a consideration, such consideration is not refundable if at least one has occurred. So for example, if a contract has been terminated, so this is understandable. If the contract has been terminated already, then the consideration is no longer refundable. Second is, if the control over goods or services was transferred to the customer and the entity has stopped transferring and has no further obligation to transfer additional goods or services to the customers. So for example, if a company has already transferred or partially transferred goods or services to a customer and the company has stopped transferring the remaining items and that the company has no longer obligation to do so, then the consideration is also non-refundable. Third here is that the entity has no obligation to transfer goods or services, or the company has received substantially all consideration from the customer. So under step 1, we should also consider the contract modification. So in some instances, we have an original contract, however, circumstances change. Hence, there are some instances when there are modifications to the original contract, right? So this exists when the parties approve a change in the scope or price of a contract. So take note, a contract modification exists if there is a modification in terms of the scope and the price of the original contract. So it is accounted for as a separate contract if conditions are met. So normally, contract modification is accounted for as part of the original contract. However, there are instances when it should be accounted for as a separate contract if the following conditions are met. So we have here, first, the scope of the contract increases because of the addition of promised goods or services that are, take note, distinct. So here, if there's an increase in scope, for example, customer want to have additional goods or services that are typically distinct from the original contract, then there's a contract modification. And this contract modification should be accounted for as a separate contract. Second here is the price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services. For example, if a customer requests for additional goods in addition to the original contract and there is an increase in the price, an increase in price is proportionate to the standalone selling price of the additional goods that the customer wants to buy, then there is also a so-called contract modification, and this should be accounted for as a separate contract. Alright, so now let's go to step 2, that is to identify the performance obligation. So similarly, let's first define what a performance obligation is. So a performance obligation is a promise in a contract with a customer to transfer to the customer the following. We have goods or services that is distinct or series of distinct goods or services. So under number one, goods or services that are distinct. So it's understandable, it's plain and simple. If the goods or services are distinct, then this is a performance obligation. However, under point two, there are cases when in a particular contract, there are many performance obligations. So we have here series of distinct goods or services. So now let's qualify what do we mean by distinct promised goods or services. So it's said to be distinct if we have three criteria here. First, it is capable of being distinct. Of course, understandable. If a particular good or services is capable of being distinct, then it's distinct. Second, distinct within the context of the contract. So separately identifiable goods or services does not significantly modify or customize another good or services. And second point, it is not highly dependent on or highly interrelated with other goods or services. So point number one, it does not modify or customize another goods or services. Point number two, it is not dependent on other goods or services. So third point here is if a customer has an option to acquire additional goods or services, and that option of a customer is said to be a material right. Now let's go to the third step, determine the transaction price. So again, let's define what the transaction price is. Transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer. So, understandably, a transaction price, from the point of view of a seller, if you are selling a goods or services, of course, you expect to receive a consideration for such exchange or for such sale of goods or services. On the other hand, if you are a buyer, of course, since you're receiving the goods or services, you're expected to pay a consideration for such transaction. A transaction price excludes amount collected in behalf of third parties. So of course, if part of the consideration is on behalf of a third party, then that should not form part of the transaction price. Second, any consideration payable to a customer, for example, coupons, credits, and vouchers. Third, other things to be considered here, take note, time value of money and variable consideration. So these are underlying items that we need to consider in determining the transaction price. So let's discuss this in great detail. So for the information of everyone, let me first introduce to you the concept of time value of money. So for example, if a seller has delivered goods or services today and expects to receive the payment within 1 year from now, of course, the value of the money 1 year from now is not the same as the value of the money if received today. That is because there are certain factors here such as inflation rate, wherein the value of money today and the value of money 1 year from now is not the same. So that is the time value of money. And hence we're saying here that it's a significant financing component. It's like since the seller has already delivered the goods or services and is expecting to receive the payment 1 year from now, it's like the seller is granting financing to the buyer. So these are the factors to be considered when assessing if particular transaction is with significant financing component. So first is when there is a difference between cash selling price of a promised goods or services and the amount of consideration to be received. So in the first case, so for example, when you pass by a cell phone shop, you see a cell phone there. Usually, cell phone shop owners offers cash selling price to the buyers. That is to entice the buyer to buy the cell phones on cash basis. However, some cell phone shop owners offer installment price, right? For example, the buyer is able to take home the cell phone. However, payments will be made in installment basis. So here, in this case, our cash selling price is the cash selling price of the cell phone if the cell phone will be paid on cash basis in full amount. Letter B here, amount of consideration received. So for example, if the cell phone is bought on installment basis, of course, say for example, cash selling price of a cell phone is 100, say installment basis is 25 for 5 months. So in 5 months, the amount there is already 125, right? So the difference between the cash selling price if bought today, that is 100, and the total of installment price of 125, the 25 there is the significant financing component. Okay, I hope that's clear. Second, combined effect of expected time between payment and delivery. The second is the market interest rates. So as mentioned earlier, if you are purchasing a cell phone on an installment basis, as the buyer usually takes home the gadget on the day of purchase, however, payment is made on installment basis. Here, there's actually an implicit interest rate on that. That is the 25 difference. So that is the interest. Transaction price should not be adjusted for the effect of the time value of money. So again, here we have the 125 if paid on installments and 100 if paid on cash basis on the day. That is, the revenue should not be adjusted for the effect of time value of money, so the 25 difference should not be accounted for as revenue. Transaction price. In case of advance payment or delivery of goods or services must be at discretion of a customer. So there are instances when a customer advances the payment and the goods or services is to be delivered in the future. So this is fine as long as the discretion is not with the seller, but the discretion is with the customer. Interest income or expense. This is recognized using effective interest method. Must be presented in the income statement separately from revenue from contracts with the customer. So this is specifically related to the significant financing component. Alright, so for example, if a customer receives a gadget today but expects to pay it like 1 year from now or more than 2 years from now in installment basis, the difference between the cash selling price today and the total installment payments be accounted for as interest expense on the books of the buyer and as interest income on the seller's point of view. And this should be accounted for under effective interest method. And such interest income or interest expense should not be lumped with the revenue or combined with the revenue, but it should be presented separately from the revenue. Variable consideration. So here, an entity must estimate the consideration to which it will be entitled in exchange for transferring the promised goods or services to a customer. So for examples, there are instances when the consideration is not fixed. So if this is the case, so the seller must actually estimate that variable consideration for the purposes of determining the transaction price. So here are the instances when there are variable consideration or contract price may vary because of the following. First, if there are refunds due to a right of return provided to customers. Second, if there are sales incentives. Third, if there are prompt payment discounts. So for example, if there are trade discounts or cash discounts granted. Fourth, if there's volume discounts. For example, a seller may grant a 15% discount if the buyer buys this much or this much quantity or this volume. Fifth is other uncertainties. So variable consideration is estimated using one of the following methods. First is the expected volume method. Second is the most likely amount. So under the expected volume method, usually we have a range of possible consideration amount. So we have more than one possible consideration, so it's usually a range. So here, for each possible amount, we assign a probability weight. And then under the expected value method, we sum the probability weight for each possible consideration. Under the second method, we determine the single most likely amount in a range of possible consideration amounts. So here, there's still a range of possible amounts, but we determine the most likely amount. And we just consider one among the range. So take note, in a variable consideration, we are actually estimating the transaction price. So take note, since we are only having an estimate, it's important that the estimate must be updated at the end of each reporting period. So still under variable consideration, we have here constraint. So revenue from variable consideration is recognized only to the extent that first, it is probable. Second, that there is no significant reversal. So again, for variable consideration, we need to consider that the variable consideration should be probable, meaning it is most likely to occur. Second, there will be no reversal. And take note, significant reversal that is expected to occur. Next, for the volume discount, this may be prospective volume discount or retrospective volume discount. So now let's proceed to the step 4. allocate the transaction price to the performance obligation in the contract. So step 4 requires the allocation of the transaction price to the separate performance obligations. So the allocation is typically based on the relative standalone selling prices of the goods or services promised and is made at the inception of the contract. So take note, it is not adjusted to reflect subsequent changes in the standalone selling prices of those goods or services. So when we say standalone selling price, it means the price at which an entity would sell a promised goods or services separately to a customer. So for example, if we have a bundle of goods that we're selling, when we say relative standalone selling price is the selling price of each good in that bundle. So how do we determine the standalone selling price? That is the observable price. So the best evidence of standalone selling price is the observable price of goods or services when the entity sells that goods or services separately. So again, the best evidence of standalone selling price. So this is the observable price when it is sold separately and in similar circumstances to similar customers. So here are the approaches when standalone selling price is not directly observable. So there are instances when we cannot directly determine the standalone selling price of particular goods or services. So one approach is the adjusted market assessment, another approach is the expected cost plus and appropriate margin, and third is the residual approach. So let's discuss this in great detail. First is the adjusted market assessment. So here, the entity evaluates the market in which it sells its goods or services and estimates the price that the customer in the market would be willing to pay for them. So basically, we determine the price in the market and we use this market price as the standalone selling price of that particular goods or services. Second approach is the expected cost plus an appropriate margin. So here, an entity usually forecasts its expected cost of satisfying a performance obligation and adds an appropriate margin for that cost. So here, what the seller does is, it determines the cost, expected cost that it will be incurred in producing such goods or services, and then the seller adds a margin or a profit to that cost, and that becomes the standalone selling price. Third is the residual approach. Here, the entity estimates the standalone selling price by reference to the total transaction price, and here we deduct the sum of the observable standalone selling price of other goods or services promised in the contract. So for example, again, if it's a bundle, okay, there's actually a price for a bundle of goods or services, right? In the residual approach, we actually estimate the standalone selling price of a particular good, and then we deduct that from the total transaction price and we get the standalone selling price. So now let's go to step 5, the last step. Recognize revenue when or as a performance obligation is satisfied. So here, an entity recognizes revenue when or as it satisfies a performance obligation, and that is when promised goods or services is delivered or transferred to a customer. So as mentioned earlier, under IFRS 15, revenue is recognized when control is transferred to the customers, and that is when there is already a transfer of goods or services, and so the performance obligation is already satisfied. So control of an asset is transferred when the customer, we have two criteria here when we are able to say that control has been transferred, and that is first, when the customer has the ability to direct the use of the asset. So for example, if the customer is able to decide or to control how the asset will be used, then we can say that the particular goods or services has been transferred to the customer. Second criteria is when the customer obtains substantially all of the remaining benefits from the asset. So for example, if it's already the customer who's benefiting from such assets, so for example, if the asset is generating cash flows and the customer is able to enjoy that cash flows, then we can say that the control of the asset has already been transferred to the customer. Next, let's proceed to how a performance obligation is satisfied. So we have two methods of revenue recognition. First is revenues recognized over time. Second is revenues recognized at a point in time. The main difference here is the timing of recognition. When we say revenue is recognized over time, meaning revenue is not recognized at a certain point, but revenue is recognized like an installment basis. So when recognizing revenue over time, we have here certain criteria, and at least one of the following must be met so that a revenue will be recognized over time. First is when a customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. Second is when the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. Third is when an asset created has no alternative use and the entity has an enforceable right to payment for the performance completed to date. Alright, so please memorize this. Now let's proceed to the second method, that is recognizing revenue at a point in time. So here are the indicators of the transfer of control which should be considered. First, the entity has a present right to the payment for the asset. Second, the customer has legal title to the asset. Third, the entity has transferred physical possession of the asset. Fourth, the customer has the significant risk and rewards of the ownership of the asset. And fifth is the customer has accepted the asset. In these five criteria, we can say that revenue can be recognized at a point in time. For example, if first, the entity has right to the full amount of consideration of the asset. And second point here is, for example, if the seller has already transferred control of the asset, therefore the customer has already the legal title to the asset. Third point here is, as what I've said, if the seller has transferred the physical possession of the asset. Fourth is, of course, since the physical possession of the asset has been transferred, the customer is already able to enjoy the significant risks and rewards of the ownership of this asset. And lastly, the customer should have accepted the asset. Now let's proceed to the balance sheet presentations. We have here contract liability. Contract liability is recognized for an entity's obligation to transfer goods or services to customer for which the entity has received consideration from the customer. So for example, if a customer has already paid to the seller and the goods or services has not yet been delivered, therefore, the seller has the obligation to transfer goods or services, and this should form part of the contract liability of a seller to the customer. For example, here, deposits and other advance payments by the customers, such as sales of gift certificates and other items. Now, when we say contract assets, these are recognized for an entity's right to consideration in exchange for goods or services that the entity has transferred to the customer. Here, this is the opposite. So, for example, if a seller has already transferred the goods or services to the customer and the seller has not yet received the payment for such, therefore, the seller has the right to collect the consideration from the customer. And this is what we call the contract asset of the seller. So take note, the seller must have an unconditional right to consideration to recognize a receivable. So here, it's important that since we're considering an asset on the seller's books, the right to the consideration should be unconditional. So when we say a right to consideration is unconditional, it means that if only the passage of time is required before payment of that consideration is due. For example, if the seller has really the right to receive the amount if it has transferred the control of particular goods and services, and only the passage of time, meaning based on the terms of the contract, for example, if the seller only expects to receive the payment after, say, 3 months, then the seller has already an unconditional right, and it's just the credit terms. So in our balance sheet presentation, contract assets and contract liabilities resulting from different contracts must not be presented net in the statement of financial position, meaning contract assets and contract liability should not be netted off. This should be presented separately on the face of the financial statements. So that ends this lesson. I hope this has been helpful to you. Comment below if you have questions or clarifications. My name is Jean. Thank you for watching. If you like this video, hit like, share, and subscribe. Till next time.